Everyone's talking about ETFs, but if you still have no clue or at least know someone who struggles with it, then this video is for you. If you stick around until the end, you'll learn everything you need to know about ETFs, what an ETF is, who it's suitable for, who it's not, how best to invest in ETFs, and most importantly, which ones to choose and how taxes on ETFs work. And for the ETF experts among you, share this video with those who are still unsure. My name is Sean Can, and enjoy the content. Let's jump straight to the first question. What is an ETF? You've probably heard that it has something to do with stocks. Imagine a company, for example, Banana Inc., that needs money. This money can be collected from investors, or in other words, from people like you. Because you can buy shares of Banana Inc. on the stock market. Just like big investors or banks, you, as a small investor, can expect that if you give your money to Banana Inc., they should manage it well and share the success with you. Let's say things go well in the first year. You might receive a dividend from Banana Inc., which is a form of profit sharing. How much dividend you receive can vary as it depends on the company's success and management decisions. But the management has an interest in giving you a decent share of the profits because they don't want to lose investors like you. The shares you own can be sold at any time on the stock exchange, but there's no guarantee that you'll get back the same amount you invested. The whole point is to sell them at a higher price and make a profit. The more successful a company is, the more people want its shares and their price generally rises. For example, you might have bought Banana Inc. shares for $50 each and sold them later for $60, making a $10 profit, or a 20% gain. This price increase plus any dividends or other payouts makes up the total return on the stock. The downside is that things could go poorly for the company, and instead of the stock price going up, it might drop. You could buy shares at $50 and end up selling them for $40, making a 20% loss. When you invest in individual stocks, this risk is relatively high. Some professional and hobby investors spend all day trying to predict stock prices, and often they're not very successful. For everyday people like you and me, it's a bit risky to invest in individual stocks. One solution to this problem is an equity fund. This is essentially a basket of many different stocks managed by a fund manager. Many investors, like you, put money into the fund, and with that money, various stocks are bought. Instead of holding one individual stock in your portfolio, you have a share of this basket and therefore hold a small part of many stocks. An ETF, which is short for Exchange Traded Fund, is also a type of equity fund. The major difference is that a regular equity fund is managed by a fund manager. This is called an active fund because the fund manager actively decides which stocks to buy and sell. However, this management comes with hefty fees, and these fees reduce your return or profit from investing. In contrast, ETFs are passive funds. They run almost automatically without a fund manager, and there's very little you as an investor need to do. That's why ETFs have much lower fees and are quite straightforward, making them perfect for small investors who don't want to spend too much time following the stock market. There are many different types of ETFs, including ones that hold things like bonds, but in this video, we'll focus on equity ETFs, which contain stocks. The question is, if ETFs are passive, who decides which stocks go into them? This is where the concept of an index comes in. You're probably familiar with the S&P 500, the US stock index, which contains the 500 largest US companies listed on stock exchanges like tech companies Apple and Microsoft, or retail market company Walmart. An ETF on the S&P 500 would simply copy the S&P 500, buying those 500 stocks. This means by investing in an S&P 500 ETF, you're effectively investing in a large portion of the US economy. When the US economy is doing well, your ETF is likely to perform well. But if the US economy takes a hit, your ETF will too. That's why you should never put all your money into a single country, company, or sector. The risk is just too high. Thankfully, there are indexes that span many countries and sectors, which help spread out the risk. For instance, one sector might be doing poorly while another is doing well, and the fluctuations balance each other out to some extent. As a beginner, you'll want to invest in a broad-based ETF that minimizes your risk. One such index I've been recommending for a long time is the MSCI World, a global stock index. It includes around 1,600 companies from 23 developed countries worldwide. MSCI, the company managing the index, decides which companies are big and successful enough to be included and removes those that no longer qualify. Every dollar you invest in an MSCI World ETF is automatically spread across all these large companies from different sectors. When you search for an MSCI World ETF online, you'll come across terms like physically replicating and synthetic. This refers to how the ETF replicates the MSCI World Index, but as a beginner, you don't need to worry about this. Another distinction that is more important to you is whether the ETF is accumulating or distributing. You already know that stocks can pay dividends. When an ETF contains hundreds of stocks, it receives dividends from each of them. The question is, what does the ETF do with those dividends? With a distributing ETF, as the name suggests, the dividends are paid out to you and land in your settlement account associated with your brokerage account. You can then decide what to do with them. Ideally, you'd reinvest them, and this is where the magic of compound interest comes in. Let's say you invest $1,000 in an ETF, and in the first year, the ETF pays out a 2% dividend. You'll receive $20 in your account. If you reinvest that $20, you'll start the second year with $1,020 in your ETF. If you earn another 2% in dividends the next year, you'll receive $20.40. Over the long term, this compound interest can significantly increase your returns, and this example assumes the price of the ETF shares hasn't increased at all. But as a beginner, it's much easier to go with an accumulating ETF because you don't have to think about reinvesting the dividends. The ETF automatically reinvests the dividends for you, increasing the value of your ETF shares without you even noticing. Now, let's talk about whether a global stock ETF is right for you. First of all, an ETF is a good fit if you don't plan on buying property anytime soon. Why? Because property ties up a lot of your money and time, which means, of course, you won't have this money or time for ETFs. Secondly, it's suitable if you don't really need a portion of your income for the foreseeable future, meaning, let's say, at least not for 15 years or so. Thirdly, it's suitable if you already have an emergency fund set aside for unexpected expenses. This should be about 3 to 6 months of net income and can be kept in a savings account. Fourthly, if you suspect that your state pension won't be enough when you retire, which is true for most people. And finally, if you still have many years left before retirement, usually at least 15 to 20 years. As you've probably noticed, when we talk about investing in stock ETFs, we're mostly referring to retirement planning. Of course, ETFs can also be used for other long-term goals, like to accelerate your wealth growth to buy a house, or start a business, or become financially independent and retire early, or travel, but their primary purpose for most people is to help you close the gap between what you'll need in retirement and what your state pension will cover. Of course, there are many other retirement saving options. We have already mentioned one, real estate. But buying your own property is of course a big decision and above all, a lifestyle choice. You have to decide for yourself what suits you better, staying a tenant or committing to your own house or apartment. We also have boring classic savings options like savings accounts or fixed term deposits, but those don't earn you much nowadays, especially when interest rates are below inflation, meaning your money doesn't actually grow, but in fact loses value. There are also state-supported retirement plans like you'll see mainly in countries like Germany, or employer-funded pensions. These can make sense depending on your specific situation, especially if the state or employer subsidies are high, but they'll never likely make up the bulk of your retirement savings and should only be a supplement. Also, private life or pension insurance plans probably won't make sense for most of you anymore because they come with high fees and don't guarantee the returns you need for retirement. Stock ETFs, on the other hand, are cheap and easy to manage. If you invest for 15 years or more, you can expect an average return of around 9% per year, which is pretty solid. This 9% is based on over 50 years of the MSCI World Index performance from 1969 to 2024. In most cases, over such long periods, you'll likely earn returns that outpace inflation, which is essential if you want to build up a decent amount of wealth. Now, let's move on to the practical side of things. How do you invest in ETFs? First, you'll need a brokerage account. This is like a cabinet where you store your ETF shares. The account should be as cheap as possible. Here on the channel, we regularly test the best brokerage providers for ETFs, and we've linked to the results in the description. When choosing a broker, look for features like a user-friendly interface and low fees for trading ETFs. And then comes the question, which ETF should it actually be? Because there's a whole jungle of ETFs out there. We make it easier for you with our ETF finder. I'll also link it in the video description below, and you can simply check which ETFs best match your portfolio. For most beginners among you, we would initially recommend an accumulating ETF because it requires no additional effort. The ETFs on the MSCI World that we recommend can be seen here. On the left is the list for if you're inside the US, and on the right is if you're living outside the US. The key difference you'll see is this marker in the name called UCITS, which stands for Undertaking for Collective Investment in Transferable Securities. The details of what that means isn't important for you right now, but in short, it is basically a European regulatory stamp of approval. This UCITS is how you know a fund is being managed from Europe. The reason you should look at the list on the left if you're in the US and on the right if you're outside the US is because as someone not in the US, if you invest from the outside world into a US based fund, you may need to pay a 30% withholding tax on any of your profits, which of course you want to avoid, which is why you should invest in the list on the right that are not based in the US so you don't have this 30% withholding tax. And within each list, which one you choose is really not that important. The name at the front, whether Xtrackers or Amundi or Invesco, simply tells you who is issuing the ETF. They are all very closely aligned with the MSCI World. This means you can't go wrong with any of these ETFs. And the number at the end, the so-called ISIN, is there so you can easily find the respective ETF in your portfolio or brokerage account. Just enter it in the search bar. Now you have the choice of whether to start with a larger sum, which you invest in the ETF in one go, or to set up a savings plan. For most beginners, an ETF savings plan is probably a good idea. For example, you could say, I want to invest $100 a month in an ETF. This amount will then be deducted from your checking account by your portfolio provider and invested in ETF shares. This means ETF shares will be bought for that $100. I would encourage beginners to start with a small amount. This can be as little as $25 a month, for example, so that you can first gain experience with the whole world of ETFs, stocks, and the stock market. And once you have gained more confidence, you can of course increase the amount month by month with your surplus income with as much money as you can truly spare for the long term. Now we come to the last question, which comes up time and time again. How are ETFs taxed? Now, this is different in every country, but here's the general idea. Basically, if you receive a distribution from an ETF or sell ETF shares at a profit, you have to pay capital gains tax on it, which can be anywhere from 0% to up to 30% in most countries. On top of that, you might have church tax as well, depending on where you live. But in some countries, there is sometimes a special rule for equity ETFs where the profits might be partly or completely tax-free. But let's look at a simple example where there is a simple capital gains tax rate of 20%. Let's say you invested $2,000 in an ETF, and the value of this ETF rises to $3,000, and you sell it for $3,000. You made a profit of $1,000. With a tax rate of 20%, you will pay $200 on this profit, leaving you with a net result of $800. Make sure to check in your own country at some point what tax rates and possible exemptions you have so you can keep more of the profit. If you have exemptions, there are usually two ways you can apply it. Either include the profit you made on your tax return, which in many countries you have to file every year anyways, and the tax exemption will be applied. Or alternatively, you can give your portfolio provider, such as your bank, an exemption order. With this, you tell them that you want to apply part of your exemption to your portfolio, and everything up to that exemption amount will be tax-free. But remember, investing with taxes is better than not investing at all. Don't let the taxes scare you. And that's all there is to it. That's everything you need to know about the seemingly complicated topic of ETFs. So go ahead and get yourself a free portfolio because it costs nothing, and start with a small ETF savings plan. If you want to know more, check out our basics playlist on ETFs here, and if you already know all of this, share this video with other investment beginners. See you in the next video. Bye bye now.